Something happened in the silver market that most people completely overlooked. Not because it was hidden, not because it was complicated, but because it happened so fast, and the narrative that came with it was so clean, so polished, so perfectly designed to make you feel like you understood it, that almost nobody stopped to ask the harder question. Silver crossed $70 an ounce. That's a number that would have sounded insane 5 years ago. It would have gotten you laughed off financial Twitter, and now it's real. And the headlines are celebrating. The gold bugs are screaming victory. The YouTube thumbnails are already made. But here's the thing that's gnawing at me. Here's the thing I cannot shake. Every time a trade this crowded reaches a round number this significant, history doesn't reward the people who were right. It punishes them. And what I want to do today is show you exactly how that happens, and why the real danger in silver right now isn't a crash. It's something far more subtle and far more dangerous than a crash. You're watching John A.G. Finance. If you're new here, welcome. This channel exists because there are conversations happening in finance that never make it to mainstream media, and they're the conversations that actually matter. If you find value in this breakdown, hit like and subscribe, because what I'm about to walk you through is going to change the way you think about metals as entirely. And share this with somebody who's been watching silver. They need to hear this. Let's go back to the beginning. Not the beginning of silver, the beginning of this particular move. Because every market move has a story underneath it, and the story underneath silver's run to $70 is one of the most layered, most geopolitically charged, most industrially complex stories in any commodity market right now. And the part that's being told publicly is maybe 20% of what's actually happening. Silver spent years being ignored, while gold was getting all the headlines, breaking records, attracting sovereign buyers, getting stacked in central bank vaults. Silver was sitting quietly in the background. It was cheap relative to gold by almost any historical measure. The gold-to-silver ratio, which has historically averaged somewhere around 60-to-1 over long periods, was trading above 80 for most of the last several years. At points, it hit 90. That means gold was nearly 90 times more expensive than silver per ounce. And if you knew anything about the historical relationship between those two metals, that screamed opportunity. But the opportunity waited, and it waited, and it waited. Because silver is a complicated beast. It's not just a monetary metal. It's not just a store of value. It's an industrial commodity with deep ties to manufacturing, to electronics, to energy infrastructure. And for a long time, those industrial channels were absorbing supply without creating a dramatic price signal. Then something changed, and it didn't change slowly. It changed in multiple places at once, and the combination of those changes is what drove silver from the high 30s, where it was sitting not that long ago, all the way to $70. So let's talk about what actually moved this market, because the explanation you've probably heard is about half right at best. The first thing you need to understand is the solar story. If you follow energy at all, you know that solar panel deployment has been accelerating at a pace that almost defies comprehension. Countries that were talking about energy transition goals 5 years out are now hitting those milestones early. And silver is irreplaceable in photovoltaic cells. Every solar panel uses silver paste on the conductive elements, and you can't just swap it out for something cheaper without losing efficiency in ways that matter at scale. The solar industry's demand for silver has been growing faster than most analysts projected even 2 years ago. And when you stack that on top of existing industrial demand, from electronics, electric vehicles, medical devices, and semiconductors. You're looking at a supply picture that was quietly getting tighter every single quarter, while prices were still relatively subdued. That's the first layer. The second layer is supply itself. And this is where the story starts to get uncomfortable. Silver mining is not a standalone business the way gold mining often is. The majority of silver that comes out of the ground doesn't come from pure silver mines. It comes as a byproduct of copper, zinc, and lead mining, which means silver supply is not controlled by silver prices the way most commodity supply is controlled by commodity prices. If the price of silver doubles, you don't automatically get double the silver supply. You get more silver only if copper miners and zinc miners decide to expand their operations for reasons related to their primary metals. The supply-response mechanism is broken, and that's a structural feature that most retail silver buyers don't fully appreciate when they're calculating how this plays out. Then you add the geopolitical layer. And this is where I want you to really pay attention, because this is where I think the mainstream analysis is most dangerously incomplete. There are 3 countries that dominate global silver production: Mexico, Peru, and China. Combined, they produce more than half of the world's mined silver. And each of those 3 countries has been dealing with internal political and economic pressures that create uncertainty around future output. Mexico has been nationalizing energy and renegotiating mining contracts in ways that have spooked foreign operators. Peru has had persistent social unrest around mining communities for years. And China's relationship with the rest of the world's commodity markets is now permanently colored by the fact that everyone learned during the pandemic that being dependent on a single country for critical materials is a strategic vulnerability. Silver isn't just industrial anymore. It's strategic. And that realization is slowly, quietly being priced into this market. Here's what nobody is asking. If all of this demand is real, if all of this supply tightness is real, if the structural dynamics actually support higher silver prices, then why does $70 feel like a trap? Why am I sitting here telling you to be careful at the exact moment when the fundamentals look this good? Because the trap in silver isn't the fundamentals. The trap is the positioning, and the 2 things are not the same. Let me explain. When a market reaches a major round number, especially a number that has never been touched before, something predictable happens that has nothing to do with supply and demand, and everything to do with human behavior. Everyone who's been right for months, everyone who bought in the 30s or 40s, everyone who's been patient and disciplined, they are now sitting on enormous gains. And those gains create pressure. They create the question, do I hold or do I take profit? And the answer to that question isn't driven by fundamentals. It's driven by psychology and risk management. Funds are rebalancing. Institutions that set price targets at 60, 65, 70. They're now at their target, and their mandate says they have to sell. It doesn't matter if they personally believe silver is going to 100. Their models say, sell at 70, and they sell at 70. And here's the other half of that same problem. Every new buyer who enters the market at 70, every retail investor, every momentum chaser, every person who saw the headlines and decided this was the moment to finally get in. They're entering at the top of a crowded trade, at exactly the moment when the experienced money is looking for an exit. That's not a crash. That's not a conspiracy. That's just how markets work. The early money needs the late money to sell into. And the late money at $70 silver is enormous right now. This is where the story changes, because the trap isn't price. The trap is time. Let me walk you through what I actually think is going to happen and why understanding this scenario changes everything about how you should be thinking about silver as an asset. In the base case, silver doesn't crash from here. What it does is something far more psychologically damaging. It consolidates. It grinds sideways. It drops to 62, bounces to 68, drops to 58, bounces back to 65. It creates a range that feels like it should break higher based on the fundamentals, but it doesn't break higher fast enough to satisfy the people who bought it at 70, expecting momentum to continue. And those people, the ones who bought the headlines, the ones who bought the round number, they don't hold through a 6-month sideways grind. They sell. They sell at 60, they sell at 55, they sell in frustration, and they lock in losses. And then, sometime after they've sold, after the weak hands have been fully flushed out, the fundamentals that were always there reassert themselves, and silver does what the fundamentals always said it would do. But the people who bought at 70 aren't in that trade anymore. This is the trap, not a crash. A grind that extracts money from impatient hands and transfers it to patient ones. Now let's think about the risk case. Because there is a scenario where silver does correct more sharply from these levels, and understanding what would trigger that matters. The biggest risk to silver right now isn't a sudden collapse in solar demand or a new silver mine appearing overnight. The biggest risk is a dollar event. If the Federal Reserve finds itself in a position where it has to signal a return to tighter policy, whether because inflation reaccelerates or because there's a credit event somewhere in the system that forces a flight to dollar liquidity, silver gets hit hard and fast. We've seen this before. March of 2020, silver dropped nearly 35% in weeks. Not because the fundamentals changed, because liquidity trumps fundamentals in a stress event, every time. And if you're holding silver at 70 with no plan for a drawdown of that magnitude, you're not investing. You're gambling. The third scenario is the one the bulls want to talk about. And to be honest, I think it's real. But I think people are underestimating how far away it might be. In the extreme upside case, silver becomes explicitly recognized as a strategic material by major governments. We're talking about the United States, the European Union, Japan, economies that are deeply invested in the energy transition, formally classifying silver the way they classify rare earth elements, creating strategic reserves, creating supply chain protection programs, and creating a floor under the price that has nothing to do with investor sentiment. That is a world where 70 is the beginning, not the end. But that policy process takes years. It takes political cycles. It takes committees and studies and white papers and lobbying. It doesn't happen because silver crossed $70. It happens because some defense minister or energy secretary gets briefed on the supply chain numbers and has a very uncomfortable realization. That realization might already be happening in rooms we don't have access to. But the market outcome from that realization is not immediate. So what does all of this mean for where we actually are right now? It means that the silver story is real and the silver trade is dangerous. And those two things can both be true at the same time. The fundamentals that drove silver from 35 to 70 are not going away. Solar deployment is not slowing. Electric vehicle production is not reversing. The supply response from mining is not coming fast enough to change the structural picture. All of that is real. But the market at $70 is priced for a version of the future where everything goes right, where demand keeps accelerating, where supply stays constrained, and where no macro disruptions intervene. And the probability of all of those conditions being true simultaneously for long enough to drive prices significantly higher from here, in the near term, is not as high as the enthusiasm around this trade would suggest. The most important thing I can tell you is this: being right about the long-term thesis does not protect you from being destroyed by the short-term trade. The history of commodity markets is filled with investors who were completely correct about the fundamental story and completely wiped out by the timing and the positioning. You can be right about silver going to 100 over the next 5 years and still lose money if you buy at 70 without understanding the structure of what's around you. What the smart money does at moments like this is not celebrate and add more exposure. What the smart money does is stress test the position. Ask yourself, what happens to my silver holdings if this goes to 45? In a liquidity event, can I hold? Can I add? Or does that scenario force me to sell at the worst possible time? If the honest answer is that a drawdown to 45 breaks your plan, then you have too much exposure at 70. Not because 70 is the top, but because your position size is incompatible with the volatility you're going to experience on the way to wherever silver ultimately goes. And here's the deeper point that I want to leave you with, because I think it's the thing that separates the people who actually build wealth from commodity cycles, from the people who just ride the narrative and give the money back. The silver market is not an investment in silver. It's an investment in the gap between where silver prices are and where silver prices need to be given the structural realities of industrial demand and constrained supply. That gap is real. That gap has existed for years. That gap is what drove prices from 35 to 70, and that gap still exists at 70. But it's smaller than it was. The easy part of this trade is behind us. The part that's ahead requires patience, risk management, and the willingness to hold through volatility that would shake most people out. That is a very different trade than the one being sold right now on YouTube thumbnails and Twitter threads. Silver at 70 is not a victory lap. It's the beginning of the hard part. The people who profit from the next move in silver are not going to be the people who bought because the chart looked good or because they saw a headline. They're going to be the people who understood the structural story well enough to hold through the noise, who sized their position correctly enough to survive a serious drawdown, and who were patient enough to wait for the full thesis to play out over a time frame measured in years, not months. That's the real conversation about silver, not the number, not the headline, the structure underneath it and the patience required to benefit from it. If you've made it this far, I genuinely want to know what you think. Drop a comment and tell me, do you think silver is in a trap here? Or do you think the momentum carries it through? Because I read every comment, and honestly, some of the best counter-arguments I've ever had to my thinking have come from this community. Share this video with someone who's been watching silver or thinking about getting in, not to scare them, but because they deserve the full picture, not just the highlight reel. The market has a way of humbling the loudest voices at exactly the worst moments. The people who survive it, and the people who eventually thrive from it, are the ones who never stopped asking the harder questions. Keep asking them.